So if you're like most people, you've probably heard a bunch of information about interest rates. In this video, I'm going to be telling you what interest rates are, how it impacts the economy, and how they can influence the performance of your investments into different asset classes. It goes without saying, but first we need to understand what an interest rate actually is. So a definition of an interest rate is the amount you are charged for borrowing money, which is an amount of the total loan, i.e. the principal. Now that we've got that out of the way, we can discuss how these interest rates impact the economy. So you've probably seen in the news that the Bank of England has increased the interest rates quite a lot over the past few months. So the Bank of England has raised the rates from 0.25% in December 2021 to now where we're at 1.75% in August 2022. This being a 400% increase in the interest rates since December 2021. Furthermore, the increase from 1.25% to 1.75% has been the biggest increase in interest rates in 27 years. So you could be thinking, who are the Bank of England and why are they doing this? Now, the Bank of England serve as the central bank for the United Kingdom, and some of their functions involve regulating other banks, maintaining monetary stability, and overseeing financial stability in the UK's financial system. On top of this, they are set a target to keep inflation at 2%. Now, it goes without saying that this has been pretty difficult for them, obviously. So this is where interest rates come in. So the Bank of England use interest rates as a tool to reduce the levels of inflation within the economy. So the way that the Bank of England does this is by setting the core or base interest rate, which will then be used to lend money to other banks or buy and sell a variety of different assets. So now we understand that, we can get into the depths of what interest rates actually are and how this influences the economy. So what is it about the Bank of England base rate that causes the economy to shift? When the bank increases its interest rate, this would represent the Bank of England tightening their monetary policy. Now, this is generally done with a variety of aims. So namely, these aims involve making people less willing to borrow, raising longer term interest rates, reducing the wealth in the population, and reducing and preventing pretty much businesses from investing, as expectations of the businesses or companies' profitability will decline. But all in all, what this generally does is it reduces individuals and companies' disposable income. So let's add a little bit more context. So when the Bank of England's base rate is increased, other banks will change or increase their rate just so they can maintain their margin when it comes to lending money for car purchases, mortgages, loans, etc. So generally speaking, this would cause the monthly repayment on those products to increase, which all in all could make them quite unaffordable for some people. Now, the impact of this is that it deters certain individuals from paying for certain products, taking out loans, borrowing money, etc., which generally encourages people to save more money because they don't want to take out a liability or an asset for that matter that would be difficult to maintain. Now, it is worth noting that doing this could plunge us into a deep recession due to the lack of spending and contribution to businesses and the economy as a whole. This, all in all, can lead to potential redundancies, the level of debt being built up and accumulated on an individual and business level, as well as potential bankruptcies. Now, it is worth noting that although the Bank of England do have that 2% target of inflation, this is actually set for the future rather than the present levels of inflation, as ultimately the changes in interest rates will have their maximum effect on inflation within 18 to 24 months after they have been changed. Nonetheless, in the present, the change in interest rates will still influence how attractive certain asset classes and investments are. So this is what we're going to talk about next. So namely, the asset classes that I am going to be discussing is cash deposits, fixed interest securities such as bonds, gilts and that kind of stuff, stocks and shares, so equities, and finally the property market in general. Starting with the cash deposits, the return on these investments are likely to fluctuate with the prevailing rate of interest, meaning that when the Bank of England's rate rises, these products will become more attractive because other banks would need to increase their rates in order to compete. Now, personally, I do think that there is a place for cash deposits in everyone's portfolio, but what I do think everyone needs to be aware of is the fact that due to the current levels of inflation, there is the capacity for the value of those cash deposits to be eroded in terms of their purchasing power. So, for example, if you had £1,000 in, say, for example, 1920, you would be able to buy a lot more relative to what you could buy with the same value of money, i.e. £1,000 in today's money. This is due to the fact that inflation rises, the cost of living increases, as well as certain goods and services will increase as well. Moving on to fixed interest securities such as bonds and gilts, etc. There is actually a negative correlation between the interest rate and the price of these products, meaning that when interest rates rise, the price of bonds and gilts is likely to fall. Now this is because the yield, i.e. the income of that product, is a percentage of their market price, which of course must remain competitive. Now an important feature of this product is that the income remains unchanged throughout the term, meaning that the yield can only change through fluctuations to its capital value. So when the value decreases, the yield will be adjusted to reflect the higher interest rate. So moving on swiftly to equities such as stocks and shares. One thing that is essential to understand about these products is that the shares and equities actually represent a portion of a company or business. And with every business there are people involved, processes, loans, debt, etc, etc. So when rates are low, this would generally mean that profits are higher due to reduced borrowing costs and the increase in demand for those services or products. So the increase in the profits may lead to an increase in the amount of dividends being paid. Now dividends generally for investors is quite valuable, so this can lead to an increase in the share price of that business, equity or share that you're holding. Now lastly, moving on to the property market, I do actually have a great example of one of my friends who is directly being impacted by the rise in interest rates. Now he is a property developer who is currently under possession of a few properties under a bridging loan, i.e. he's using bridging finance to purchase these properties. Now for his particular strategy, he is required to move from the bridging loan to a buy-to-let mortgage. So previously, before, he informed me that he was able to secure a buy-to-let mortgage product at a rate of around 4% of interest. Now since the interest rates have increased, that same particular product is now offering rates of about 6%. So what this would actually mean is that the monthly repayment of that mortgage payment would be higher now compared to what it was at the 4%, ultimately leading to a reduction in the level of cash flow coming from that property. So this is a great and real life example of the fact that interest rates, especially within the property market, can impact the amount of cash flow that individuals and property investors alike may suffer from. Now unfortunately, this can lead to set individuals being unable to keep up with their monthly repayments, which, you know, if they can't keep up with it, ultimately could lead to people selling more houses. Now, what could happen with the market in general is a difficult one to predict, but based on supply and demand principles, the fact that more houses will potentially be sold will increase the amount of supply in the property market. But where it becomes a bit difficult to predict is where the demand will lie. Of course, we know that the interest rates are going to cause higher repayment costs. This could deter a lot of potential landlords, or on the flip side, it may offer some room to acquire some properties below market value. So all in all, I feel like this can be perceived in one of two ways. This can be perceived in a way where this can work for you, or on the flip side, it could work against you. It all depends on your personal circumstances, but you need to ultimately take responsibility and decide what is best for you. So that is all for today, guys. I am going to be dropping quite a bit more content in the personal finance realm. So if you do have any suggestions, please make sure to send them through. As for now, make sure you like, comment, subscribe. Take care, guys.